U.S. stock futures sinking this morning as tariff fears grip markets. The risks posed by the levies prompting Goldman Sachs to cut its year-end target for the S&P 500 for the second time this month, saying if the growth outlook and investor confidence deteriorate even further, valuations could decline much more than previously forecast. Joining us to discuss more, we've got Yahoo Finance markets reporter Josh Schaefer. Josh, I know you've been all over this note this morning. Talk us through it.
Yeah, so it seems like these tariffs might actually happen. And now that we start putting that into the forecasting numbers, the numbers don't look as good, right? And I think that's really been the realization that we're looking at across the forecasting space really over the past month, specifically over the past 24 hours, right? So the key to Goldman's call here really, when we think about sort of their economics call, you guys mentioned they raised their odds of recession to 35%. They ticked down their growth forecast, ticked up their inflation forecast. It's about their effective tariff rate number, right? And they put up their tariff rate forecast now to 15%. What does that do to the economic forecast I just mentioned? Sort of creates this stagflationary environment, right? Where inflation goes up, economic growth goes down. What does that do for stocks? Not a good environment, realistically, to have tariffs of 15%. You think back to the Barclays call we talked about last week. They also now see the S&P 500 only hitting 5,900 this year. Also key to that call, Vinu Krishna told us we hadn't really accounted for tariffs at this point yet because we didn't know what to put in there. Now, if we put in a baseline of 15%, doesn't look so hot. Yeah. You look at Yardeni Research, also moving down their S&P 500 called the 6,100. Ed Yardeni wrote countless times throughout that note that, quote, Trump's reign of tariffs have changed the outlook. So I think really you're seeing it in both forecasting and then also S&P 500 futures today, right? And just the general market. We're starting to come to the realization this thing's going to happen on Wednesday.
Yeah.
And there's going to be more tariffs than maybe people had initially thought.
And that the markets cannot strong arm him into changing his mind, right? Because the so-called Trump put that a lot of folks have talked about, if stocks pull back far enough, he'll blink. That hasn't really been borne out, both in actuality and also in his rhetoric, right? Where he says he's willing to put up with some declines in the stock market.
Well, because also, Julie, I think things have felt chaotic, but when you take a look at how much the indexes are at least down year to date, the S&P 500's off, I think, about 5% this year. Yes, we hit that 10% correction mark from an all-time high, and we hit it pretty quickly. And things have been bad, and I'm not trying to downplay that a lot of people, of course, have lost money in various different stocks. But overall, we haven't come down that far. And so, where is your Trump put number? I would imagine it would probably be significantly lower than where we are right now, right? And I think you're starting to hear more people talk about maybe a bear market. That would be the S&P 500 getting closer to 4,900. And so maybe there's just more of this to play out, I think, and perhaps more selling action, more downside at some point.
And we also just wrapped up the first quarter of the year, obviously. To what extent could this earnings cycle affirm or deny the tariff boogeyman in the room as something that's going to continue to weigh on stocks moving forward?
I think that's probably one of the largest looming questions right now, right? So I highlighted in our newsletter this morning, our chart of the day was a chart from FactSet talking about S&P 500 earnings guidance cuts, right? So they define a cut, or sorry, I should say negative guidance. They define negative guidance by just anything that comes below the street. Well, there's been a little over 60 thus far out of only 100 companies to give guidance. A little over 60 have been negative. That's above your 5-year average, above your 10-year average, and I think the looming question is how much further that number continues to go up. Essentially, analysts were very optimistic coming into this year, and we're seeing that re-rating start to happen right now. But I would think as you go through the next month, we really have earnings kick off next week, right?
Yeah.
I think you're probably going to see more cuts, and then you sort of get to okay, where are we now? Where is the reality situation? And I don't think we're getting that answer on Wednesday, and we're probably not getting that answer at the end of the week. I think that's sort of the looming message from all of these calls too is, okay, this is the start of it, and now we're entering into longer term of uncertainty while we try and sort of price this out.
Yeah, I heard a really good point from Lori Calvasina over at RBC in an interview this morning where she was asked about the so-called hard data versus the soft data, right? The survey data, what we say we're going to do, versus the hard data, what we actually do, what we actually spend on. And she said, well, you have those traditional macro data, but she said, we as strategists have our own hard data, and that's earnings, right? And that data has not been great so far. What we have heard from companies, particularly consumer-facing companies, has been that they're concerned. And so now we're going to get more from a broader swath of companies to see if they confirm that.
Well, and I think even relating that to the market action too, Julie, the most interesting part of this sell-off to me has been, we keep talking about the tech sell-off and sort of where the concentration has been in the selling action. Well, if we're afraid that wider tariffs are coming than we initially expected, my question is, how much is that impacting tech versus perhaps maybe impacting some of those consumer companies more?
Yes.
And then when you think about there maybe being more selling to happen there on a company-specific basis, I don't know if we've seen all of that priced into the actual companies that are going to be impacted by tariffs the most. You look at Staples doing pretty well this year. I'd guess consumer staples are going to have a hard time if we slap tariffs on everyone, right?
Yes.
And so I think that part of it and that piece of it, we saw this with autos last week, right? You thought, okay, we've talked a lot about these auto tariffs. We're sort of ready for this. GM stock didn't really look like it was ready for the level of tariffs that we eventually found out, right? And so I think when you think about where the market's at with what we're expecting to hear versus what we're actually going to hear, it seems like, at least on an individual stock basis, certain stocks have struggled with the actual number.
To your point, the worst performer in the S&P 500 this year on a percentage basis, I'm not going to tell you what it is. It's a consumer discretionary stock. It is not a tech stock. And we're going to tell you what it is a little bit later in the show.
So it's not Tesla.
tease.
It's not
It
Tesla.
is not Tesla. It is consumer discretionary, but it's not Tesla.
That's a deep tease. I'm staying
It's more
tuned
in
in.
the consumer realm.
Okay.
We'll talk about it later. You got to keep watching, and so do you, everybody else.